We are live.
We're live.
Daniel is finishing up a piece of toast. And my name is Jake. We are bringing you Stock Unlock podcast number 55. Daniel Pronk is Canada's #1 investing YouTuber by subscriber count, and I am his business partner and engineer. Not only are we building Stock Unlock, but we come to you guys once a month to talk about stocks. And today we have a lot to talk about. It looks like the market is crashing. Daniel is coming in, eating his toast, so we could take prediction markets on that. If he's going to get another piece or not. It looks like your video is down, Daniel.
No one wants to see this.
No.
All right. No one wants to see me eating a piece of toast. This is some real life live stream, you guys. I have had no time to get breakfast. I'm starving. I just ran downstairs, made a couple pieces of toast, slapped some peanut butter on it, and here we are. Let's go. I'll be done in like a minute.
Well, this is the life of a fast-growing YouTuber. I wanted to say congratulations, actually, Daniel. As a friend and fellow viewer, I think that you had your first 100,000 plus view video in a very long time recently, and it looks like your content is like really catching. So I just want to say nice job and well-deserved. I mean, I have been loving your videos recently. I'm not sure if anyone in the chat wants to chime in. I'm sure most people here are aware of your regular channel.
Thank you. Appreciate it. Yep. Things are going well over at the Daniel Pronk channel. Let's go.
All right. Well, Rob H has a great idea there. In the spirit of you eating toast, we will look at a stock called TOST, which we will pronounce toast, even though it's probably TOST. And I'll be honest, I've never heard of the stock before. So let's even see if it is a stock. Oh, wow. Okay. TOST is Toast Inc. Let's see. Daniel, is this a weird prediction where... Okay, you were only eating a 3.27 insight score, so let's see what this company does. Got a nice toaster logo. See, they engage in the development and provision of consumer payment applications for restaurants. Interesting. I was just watching a video online of a startup called Burnt, which was also in the business space where they were creating payment solutions for restaurants, and the venture capitalists listening to them said that there are a lot of dead startups in this space. So my first question whenever I see a business like this is, what is their moat and who are their competitors?
Should we make a company called Burnt Toast and we can just combine the two?
We should try to get Toast to acquire Burnt or the other way around, or we can make Burnt Toast and then acquire Burnt and Toast.
There you go. Genius.
All right. Well, it does look like this company gives out a lot of stock-based compensation that is not great to see. So we'll take a deeper look at that. This company is not profitable and seems to be losing money, but they do have high growth. So I do wonder if this is a revenue growth, but not profitability growth trap, even though it does have a very high growth score. It also seems to have a decent balance sheet. While they're not profitable, it looks like they are debt-free, and it seems like they are cash-rich while having their shares increase. So it'll be interesting to see how this company is making its money. So let's head over to the financial statements, eh?
Oh, yeah, bud.
Well, I can tell you one thing, Daniel. They're not making money off of their revenue that they're pulling in. Or in other words, the expenses that they need to pay for to generate their revenue are more than their revenue. So this company has negative net income. One good note about the revenue is it is growing pretty consistently. This growth rate actually has been pretty consistent for the last couple of years. At every period on a TTM basis, it looks like they're growing around 6 to 10%. It is actually in a slight decline. And when you toggle the quarterly view, yeah, it looks like they are generally growing every quarter, so you can never knock that. It's not a terrible thing. But I was curious about their diluted shares outstanding. Now, it does look like they are diluting shareholders over time to raise money.
Nope.
Which is something we do not like to see.
Nope. I would say that dilution is probably from stock-based compensation, because what is stock-based compensation? It is dilution.
Dilution.
No.
Say it with me, folks.
This could also be a company where the net income is negative, operating income is negative, but they might have positive cash flow because stock-based compensation is subtracted from net income, but not from cash flows.
Yep. And thankfully in Stock Unlock, we separate out these numbers. So I'm saving the best for last there. But yeah, you can see they keep their cash position pretty constant, and their balance sheet just right off the tip of the nose. No red flags. For anyone looking to actually make an investment in here, you would want to go down to the 10Qs or 10Ks to really look at their assets more closely. But no red flags on the balance sheet. And let's see if you are correct, Daniel. What happened back here? All right, it looks like they issued a lot of stock. which is those big purple arrows to raise money. It does look, Daniel, like they are starting to generate. Okay, I'll take that back. They have generated positive operating cash flow, but not consistently. So if you look at a TTM basis in some of the last 4 quarters, it looks like it's going up. But when you go back to quarterly, it looks like after 3 quarters of positive operating cash flow, they went negative again, which kind of stinks. Their free cash flow is also negative. And then when you look at their free cash flow excluding stock-based compensation, it's not looking super great. As you can see, it looks like they consistently give out around 70 million equivalent of stock-based compensation per quarter, which is a very interesting reward mechanism for management that is not running a profitable company. Finally, that gets me curious to look at the insider transactions, and not surprisingly and kind of sadly, not only is the management giving themselves shares for what looks like an amazing performance of eating toast, looks like they are selling a lot of shares as well.
Yeah, not what I look for.
Maybe I could just cut it off here, but
lots of red flags for me.
Okay, so here's all right. Let me give a little bull narrative here. This company has been growing its subscription revenue. I will make an assumption here that this is revenue that is recurring. So people like Warren Buffett do love recurring subscription revenue. It does seem like most of their revenue streams are like growing. So this company is growing top line. That's of course good to see. Their balance sheet is safe. However, there is a lot of shareholder dilution from stock-based compensation, and it seems like there might be some mismanagement going on that's not very shareholder aligned. So if management starts to get their act together and they keep growing, I mean, they can turn that revenue into profits. However, haven't proven that yet. And that's the most nice thing I can say here.
There you go. All right.
Well, that was a fun one. Looking at some toast while Daniel's eating toast. Oh, we got 41 people in here. Nice to see you all.
All right, Jake. What do you think about this recent selling that we've seen across the mega, what is it, the Magnificent Seven, and the overall market, and semiconductor stocks and whatnot? We're seeing a lot of selling. What is Meta doing today? Meta has been falling quite a bit too, actually.
I think that everyone is wrong when they say the market is falling or rising. And I'm going to just flip this back at you because you're the YouTuber. I think that you have way more elegant speech than I do when talking about this macro mumbo jumbo, but I'll tee it up for you. It is no secret, especially for those watching our show, because most of us are investment nerds, that there have been 7 companies in the S&P that have been carrying most of the index. No, I am not unique for figuring that out. So the question I want to flip over to you, Daniel, is why do people use the term the market? Because to me, the market is kind of divided into different pieces. And when people say that there is a dip now, I zoom out 1 month on the chart and I see that the S&P and all the major indexes are still trading higher than they were a month ago. And I think that there's too much recency bias and things only going up. And I do fear that investors are just getting a little bit greedy, and people are starting to come into the investment world just expecting that things only ever go up, which we obviously know is not the case. So yeah, I'm curious how you view this. Are you seeing the market more segmented? And do you even think it's fair to say the market is up or down?
Well, I mean, you're really asking terminology versus reality. It's just, the market is just a term for the S&P 500 because that's typically what people use as like, what is the overall market doing? So yes, what is the market? Well, the market is actually what would it be, like 8,000 public U.S. companies now? But the market in the term we're using is the S&P 500. So what do I think about it going down recently? I would actually agree with you a lot that people do have recency bias. I write about this a lot in my book. People tend to really focus on like what is happening today. And I get asked this question a lot being a YouTuber. Like when I talk about Brookfield, for example, Brookfield has run like 50% almost in a straight line over the past couple of months. And then it will dip. Yeah, everyone take a drink. And then it will dip 2% on the day. And then I get asked, why is Brookfield crashing today? And I'm like, if you look back a month, it's up 30%. Like what it's not crashing at all. What do you mean? Right. So yeah, I think just like zooming out is a very good move for everyone. Don't focus on the day to day, really just zoom out on all the positions. That being said, I also agree with you that if you take a look at the S&P 500 since that dip we had in 2022, that 25% correction we had, it's been basically straight up. So I think that people who have entered the market over the past about 18 to 20 months now, actually, all they've seen is just a nice, consistent uptrend. And the longer these uptrends go, the more it's funny because it's like the reverse of what should be happening. But the longer these uptrends go, the more people think that they're going to continue, which is like the absolute inverse of reality. So when I've been giving my talks, I've actually been doing a few talks recently at the Blossom events that I've been going to. And the questions that I've been asked is like my overall views on the market right now in this AI bubble and everything like that. And the messaging I've been doing is just like, I think people need to lower their expectations because the market is up something like 15% so far this year. 15% for a full year is usually very, very good returns for the market. Okay. We're up 15% in 7 months. So I'm telling people like, this is not a normal environment. Okay. This is not normal. Expectations should be lowered. I actually got a text from, I won't say who, but it's someone pretty close to me. And recently, like literally last week, they're like, oh, my portfolio is up 9% this year. Like, I'm really hoping this continues. And it just keeps going and it accelerates and I make more money this year. And I responded to them and I was like, no, it's probably not going to continue. You should not expect this every year. Like, this is a very high return year. Calm down. So I don't know. That's kind of my perspective on the market right now. The market being the S&P 500. Now, with that being said, what am I doing in my portfolios? I'm like pretty much fully invested. Probably
Buying more Brookfield.
Buying more stocks. I will say though, like I'm usually someone who finds a lot of value in the market no matter what it's doing, but even my stocks have run a lot. So even now I'm like, there's not that many more names that I'm adding to still. But I'm still finding value. I'm still buying.
Sweet. Well, yeah, I think that was well said. I don't have anything to add there other than like agreeing with you. I mean, I think for most investors, like talking about the market, I think is just like a dangling carrot in front of your head where it's not actually helping you. It's kind of like worry, never walk the dog. Like when you worry about something, worrying is not going to help your problem. I think focusing on the market isn't really going to help your investments that much because there's just so many different angles to it. So
the
be like Daniel, look at individual stocks and know them well.
Yeah, the CEO of Brookfield, Bruce Flatt, he actually writes in his annual letters that the market is a giant distraction from investing. Like, people focus too much on the day-to-day and you should really just be focusing on the long term and investing in great businesses for the long term and just focusing on businesses that are growing their fundamentals every year. Yeah. But it's distracting, when prices are jumping around so much day to day.
Yeah. And just as a reminder, Daniel and I are not financial advisors. This is not financial advice. This is just for entertainment. Please talk to a financial professional before making any investment decisions. And yes, you can take a drink for that. I think that there's a good question here for you, Daniel. So instead of talking about the overall market, I do have a typo correction in this one. In which sector do you see the most potential? So tech, maybe we could even look at this as large caps and small caps, even though that wasn't the direct question, but sure. So here's the answer. All right, Daniel, I get it. I shouldn't look at the whole market, but I have to look at something. And if I don't know, and if I'm looking for ideas, like what sector can give me good investment ideas right now that like might be undervalued?
Well, this question might need to be more specific. Which sector do I see the most potential in fundamentally or price-wise? Those are two different things because there's sectors where the businesses are growing very, very well, but the stocks are all trading for 50 times plus cash flows, which is way too high. So it's like, where do I think there's almost obvious growth? I would say cybersecurity is almost guaranteed to continue growing over the long term. Cybersecurity is becoming a bigger and bigger issue every single year at an accelerating pace. Also, infrastructure, I think, is going to be very important, especially electrical infrastructure, because the limiting factor of AI development right now is actually literal electricity. So we need a lot more electricity. So I think that there's going to be a lot of growth there. And I think that would be like the two that I would be the most optimistic on fundamentally growing. But
I have one to add there as well. The travel industry, I think, is going to continue to grow over the next decade or two. So that's like more of a long-term macro thing. But the amount of people flying, the accessibility of vacations, and the cost of like traveling with inflation actually is like going down in some areas depending on what kind of travel you're trying to do. So I'm a huge Airbnb guy, and someone brought up Booking.com too, which might be a nice comparison in stock to look at. But I do think that industry as a whole, with the exception of airlines, I think that airlines are a exception asterisks. Those are very hard businesses to run profitably.
Yeah, there's no moats in airlines.
It's so weird. Like there is and there isn't. Like it's so hard to like get into the airports, right? Like get airplanes. Like I do think that there's a high barrier. However, it is like a mature industry, and you are right in that. Yeah, the margins there, if you look at airplane stocks, are pretty terrible because people are just shopping for the best rate, basically.
Exactly. People just care about getting the cheapest ticket. I would also say railroads. I think railroads are one industry where I would say are almost guaranteed to grow over the next 20 years. They're not going anywhere, man. Railroads are too efficient.
So I'm going to ask for your permission here on something, Daniel. There's a lot of people talking about Booking.com, Expedia, and Airbnb. And I think a free form foray into those stocks could be a fun time. However, I ask for permission because I can get carried away on my own bullishness on this. And I know we've talked about it before. How are you feeling on bringing that up versus taking another comment in the chat? And for those listening, let us know where you'd like us to take this. We love interacting with the chat. And lastly, if you are listening to the recording of this on Spotify or Apple Podcasts, we always film these live on YouTube and come hang out with us sometime.
Yeah, go for it. Booking.com is coming up a lot recently, I think, because Joesph Carlson just bought it and made a really in-depth video. Like after that video,
I watched that.
I've seen this ticker come up so many times after that video. So yeah, let's take a look.
Yeah. Well, I mean, one great YouTuber. You're talking about Joesph Carlson, right?
Yeah, he's friggin' great YouTuber.
Yeah. You two are like tops in my book there. A lot of respect to that guy. And I did actually watch that video. I mean, I'm a big investor in Airbnb. I have looked at Booking.com a lot, but yeah, I figured we'll actually start off on the insights for these companies. I'm actually not super into Expedia, and we can get into why a little bit later, but let's just start comparing Airbnb with Booking Holdings. I'll kind of wear my opinion on my sleeve here and say, I actually think both of these are great companies, and people don't understand something about me. When I go and invest in Airbnb, it's not a binary thing that implies that Booking.com is a bad company. I actually think they're both really good companies. I have my own personal reasons for thinking that Airbnb has the biggest potential to outperform. A lot of that is with their founder-led CEO, as well as their product innovation and where they sit in the marketplace being directly between consumers as opposed to a proxy. But that is up for debate. Just looking at them super high level, almost identical profitability score between Airbnb on the left and Booking.com here on the right. Both of these companies are converting a lot of cash earnings and free cash flow from their revenue. Management score a little bit better for Booking. Airbnb is a slightly smaller company and definitely does more stock-based compensation. I'm not going to try to argue that as a good thing. I think investors should be aware that Airbnb does incentivize through stock-based compensation more than Booking. However, it continues to break down. Airbnb's growth is wildly better than Booking on all metrics. And I actually thought Booking had a better balance sheet than this. Looks like Airbnb is a little bit stronger in the balance sheet area as well. But as you can see, Booking is buying back a lot of shares.
Booking bought back 8.7% of their shares over the past year.
Oh, you know what? Let's we're going to the freeform tool. So for those of you who aren't super familiar, we are using Stock Unlock. Full disclosure, Daniel and I are the two co-founders of this business, and what we're using right now is the freeform tool. And it is my favorite for just getting super nerdy and deep on comparing stock fundamentals with each other. It's totally free to try a lot of these tools too. And of course, we do have paid plans because we are a business at the end of the day. But yeah, where should I even start here, Daniel? I mean, do you just want to look at the share count management just because we left off there? Because Booking is buying back shares.
Yeah, you're going to want to zoom into where Airbnb starts, though.
Our math here will properly compute and not add in these zeros. But
okay, cool.
Yeah, so you see how Airbnb is constant down there? Dude, we got the math right. That was actually a bug when we first released this, but we listened to our users and fixed that stuff. So anyways, you can see compound annual growth rate for the last over a decade for Booking on average, 4% share decrease per year in buybacks. I mean, that's great.
Yeah, that's a lot.
Yeah. Straight up, I mean, I've looked at both these companies a lot. Booking has obviously been around for a lot longer than Airbnb, and they also bring in more revenue. They have a more diversified product offering in that they sit between a lot of like hotels and other experiences. So they do definitely directly compete with Airbnb for, no pun intended, booking volume. Let's just bring up the revenue for these companies just to illustrate this more. So as you can see, Booking is by far up here. And then if we zoom in to just look at the last, let's say 4 years, you can kind of like look at the growth rates. Airbnb is growing a lot more. However, it is really important to recognize that they're growing from a smaller base. So it is easier to get higher percentage gains when you're obviously growing from a smaller number.
Correct.
And yeah, let's bring up the operating cash flow and then price to operating cash flow. So now we're going to start to look at the pricings of these stocks. I haven't talked too much yet about Expedia, and apologies to anyone who is bullish on Expedia in the chat. When I looked into this company, I was not able to get any good feeling about their culture or the people that are working there. It does not look like they're innovating a lot. It looks like they purchase and own a lot of other businesses that, in my opinion, like quite frankly, are just they're just like managing them almost like a private equity firm would, buying things out. So I did not really get excited about Expedia. I couldn't really see their future product roadmap. And when I looked at Booking and Airbnb, it looks like they were moving quicker and out innovating Expedia, just in my frank opinion. But yeah, let's look at the operating cash flow now. I mean, the latest values, Airbnb has produced over 4 billion, Bookings over 7, and Expedia is down at 2. So Airbnb is already producing a lot more cash flow than Expedia, but still less than Booking. And then if you look at the growth rates, and one of the most impressive things here is Booking is compounding its operating cash flow at a rate that is almost unconscious. This is only over the past few years, but yeah, this will be a little bit more realistic. Here you're seeing they compound at around 10%, and as of lately, with the rebound from travel since COVID, their numbers are going way up. So yeah, for investors to take this more on their own, just so I don't start boring people, the way that Booking and Airbnb operate is like pretty different. So I would go to their investor relations pages and really understand the product they're offering. And straight up, I have considered multiple times actually owning both stocks. I just really don't have much negative things to say about Booking. I think that it's doing very well.
Yeah, they're doing well. The company's been growing very consistently for a long time. I just took a look on my own screen. Booking is buying back more shares than they produce in profits. So they are leveraging up the balance sheet a little bit to buy back as many shares as they are. So it's an unsustainable level of buybacks, and they are taking on debt to do so. The dividend investor CPA said they plan to leverage up a bit, take their net debt to EBITDA level to 1 to help calculate buybacks. Still will be net cash as well. So yeah, they are leveraging up the balance sheet a bit to buy back shares. As long as the price is cheap, I don't necessarily have an issue with taking on debt to buy back shares. And I do think that Booking's price today is arguably cheap. They're under 20 times cash flow, I think. So yeah, it's interesting. I think all these companies, well, I won't say all, I don't know Expedia very well, but I think Airbnb and Booking are both really great companies. Strong fundamentals too, like very profitable, consistent growth outside of COVID. So yeah, there's not really a lot to dislike.
Yeah, and this might be a little bit hard to read. I'm kind of like a math person, so let me know in the chat if these graphs are just getting a little bit too busy for people. But these solid lines you're seeing are, let's remove Expedia from here. That'll help.
Yeah, I would.
Sorry, Expedia. The solid lines you're seeing in here are the market cap. So you could actually see when Airbnb IPO'd, the market didn't really know how to quite price it. They're a fast-growing startup, and it kept leapfrogging back and forth with Booking. But since the end of 2022, the market has consistently comped Booking with a higher market cap. I actually think that's deserved. Again, they're generating more operating cash flow. They have been buying back shares, so the operating cash flow per share has also been growing well. So I think it's fair. However, my prediction, which is just my own opinion, this is not financial advice, is over time, I see Airbnb out innovating and outgrowing Booking. No, that does not mean that I think Booking's going to go out of business or be a bad company. But I like to try to bet on the winners. I could be wrong here, and there's a lot of people that disagree with me on that. But based on my experience, based on my research, that's where I'm at currently.
Yeah, fair enough.
They're priced very similarly too. So you can see this price to free cash flow line down here. They're almost hugging each other consistently, with Airbnb getting a slightly higher multiple than Booking.
All right, I'm going to take a new question here. Yan says, what do you think about the sector rotation theory out of tech? And can you look at Verilia stock? I mean, I don't know if this is necessarily a theory. There's money clearly moving out of tech and into other sectors. So I'm not sure that's a theory. That's just kind of like what I think is actually happening right now. And in terms of that, I mean, I don't think it's a bad move. Google is selling right near its all-time high price to operating cash flow ratios. So on an operating cash flow basis, the stock is literally right near as expensive as it ever gets. And then typically when Google sells for these price ratios, it sees a period where the stock doesn't produce returns. A good example was back in 2021 when Google topped, well, before the split, it was $3,000 per share. I believe the price to operating cash flow was like 20, it was in the 20s, maybe like 24, 25. And then there was a 2-year period where the stock didn't produce returns because it needed to correct itself. The price ratios are right back up. It's just as expensive as it was back in 2021. So I think that there is at least a decent argument that Google is actually quite expensive right now, and people are looking for higher returns. So they're rotating out of tech after the great run it's been on, and they're looking for cheaper stocks. I don't think that's a bad move. I've even debated trimming some Google on my own because, again, last time Google was at this price, it did nothing for 2 years. So yeah, that's kind of my opinion on that.
Yeah, that rings in my head too. Especially, you said something at the beginning of this podcast. You said getting a 15% return in a year is actually a pretty good market beating return if you average it out. And
yep,
I'm of the same mindset. So while it does make me happy that like Amazon and Google quickly doubled on me, I mean, we talk about this a lot. You and I both loaded up at the end of 2022. That's when I started and built most of my position there. I mean, I've doubled on Amazon and Google in a year and a half. And it does make it really hard not to trim a bit because I don't want to like trim the flowers of my fastest growing stocks. However, I do agree with you that if you're trying to time the market a bit, it does look like it's getting to a price where unless they continue to really outgrow people's expectations, that the price multiples will not expand forever. They will eventually rubber band themselves back in.
Yeah. And I'll show you some interesting things because I was taking a look at these two yesterday, actually, because I actually was debating trimming some Google. I have not touched my position yet, but yeah, like I was thinking of rotating some money out of Google and into some other stocks. So if we take a look, this is Amazon and Google's price to operating cash flow over time. Google is the green line. Amazon's the blue line. And you can see that basically throughout history, outside of this little blip here in 2010, Google has always sold for a cheaper price to operating cash flow than Amazon. Except if you zoom in right now, it's actually trading for a premium over Amazon, which basically over the past 14 years has not happened. So I was actually thinking of maybe trimming some Google and throwing it into Amazon. I'm actually more bullish on Amazon as well. Again, I haven't made any moves, but these are the thoughts that I'm thinking right now.
Yeah, someone did bring up that in the chat. Like, do you have the same thought with Amazon? The price to operating cash flow is under 20. So
no, well, here I have a couple things. Let's zoom into 2014 so we can take a look at a decade view. Amazon's historical average price to operating cash flow is 27.3. Currently, it's at 19.7. So it's actually trading about 30% below its averages. Google's average price to operating cash flow is 17.8. It's trading for 21 now. So it's about 15% above averages. So relative to how the market has historically valued these stocks, Amazon's cheap, Google is overpriced. Additionally, what I wanted to show everyone is if we can zoom into the bottom of the market in I think it was like November. Yep. So what I like to do is take a look at price ratio expansion as well. So Google back in, where was the low? The low was actually December. Let me zoom in, try and get the low. Okay, so if we take a look at Google's price to operating cash flow, we're taking a look at the bottom of the market. Basically at the start of 2023, Google was trading for a 12 price to operating cash flow. It's basically almost doubled now. So Google's share price returns have actually come from multiple expansion. And we can see right here, the multiple has expanded by 41% annually over the past 18 months-ish. So Google's quite literally, Google's share price returns have just been the market pricing the stock higher. It has had a little fundamental growth, but very, very little, okay? So it's literally just like the stock became more expensive. Whereas with Amazon, it was trading for an 18 price to free cash flow or price to operating cash flow. Today it's 19.7. And the compounded annual growth rate is actually negative over this time period. So Amazon's share price returns since the bottom of the market in 2023 was all fundamental growth, no multiple expansion. That is the complete opposite for Google. So when you take a look at where did these stock price returns actually come from, for Google, it's the market pricing the stock higher, multiple expanding. For Amazon, market's not pricing the stock higher, but its fundamentals actually grew incredibly well. So that's why I think Amazon is also like the better company. I'm more bullish on it. You can also take a look here. We're looking at the same time frames. Over the past 18 months, Amazon has grown its operating cash flow by 82.5%, Google by about 20%. So
that
Amazon,
is so insane that they're still growing their operating cash flow at that clip, at like these high levels. It still blows my mind.
Well, to be fair, they were in that dip right here. So
yeah.
But you can also see, like, just zoom out at Amazon's operating cash flow growth. Like, Google's the top line, Amazon's the bottom line. Like, this is an explosion right here. Like, Amazon is growing profits so quickly, and now it's trading at a cheaper price than Google, which again has not happened in the past 14 years. And for all those reasons that I just discussed, I was like, I think there's a strong argument that trimming Google and putting the money in Amazon for myself wouldn't be a bad move right now.
Are you one to try to time the market like that, or do you even agree with my question? Because when I hear that, like, I totally agree with you logically. And then, of course, the counter thought is don't trim your flowers that are growing. Don't sell a great business. Are those principles that you follow? If so, when? And then, like, there's no right or wrong here, right? But, like, would just love to dig into your brain more because I feel like I might be a bit conservative. Like, let's see what Alex brought up here. Because this is exactly what we're talking about. Like, I am torn on selling Google, not because I think it's overpriced, but it's one of my buy and hold positions. So, like, this is exactly my dilemma. I feel like when I watch your YouTube videos, it helps me, you know, like, kind of like think a little bit more clearly. And right now I feel like my vision's very fogged, right? Like, half of me wants to sell and move things around. The other half is don't time the market. You know, that doesn't work. What should someone in my position or the people in the chat here, like, be thinking? Or are you also just as confused?
There's no one answer. Like, as I've been telling my Patreon community a lot more recently, like, what I've realized is when you're talking about investments, almost all the time the answer is it depends. Like, everyone is different, so it just depends.
Let's change the question then. What do you personally, which is not financial advice to anyone else, think about doing in terms of this Amazon Google conversation? Like, where's your head at in terms of, like, you're going to go execute the trade after this call to move money around, or like you're thinking about dollar cost selling some Google, going back and forth?
Yeah, I don't know. Like, I don't know if I would sell the entire position or not. I also, I don't know if, let me back up. I don't know if timing the market is the same thing as, like, I think a stock is expensive, so I want to trim it down. That's not me saying Google's going to continue, or that's not me saying Google's going to crash tomorrow or the stock is going to be flat. It's just like, you know, the price is high, making me a little bit uncomfortable personally. So in that scenario, may trim it down. That said, I do have stocks in my portfolio like Constellation Software, where it's selling at a higher price than Google today. The price to free cash flow is like 35 or something like that. I'm not going to sell it. That's a stock I'm not selling. I don't care what the price does. I'm not selling it. So I have different mentalities around different positions in my portfolio. Google is not my highest conviction stock. It's one of my smaller positions. So it's like, that one I'm more inclined to be able to, like, oh, well, it's looking expensive, trim it. But for other stocks, that's just not my mentality. Brookfield's another one. I don't want to sell Brookfield. If Brookfield doubles tomorrow, I'm not going to sell it. But, like, if Google doubled tomorrow, I would sell it. So it's not, even within my own portfolio, the answer is it depends. Like, investing isn't easy. It's not meant to be easy. That's just what it is.
I think that's a great answer. Because, yeah, for me, like, I bought like a coal mining stock and it ran like 20 something %, which was what I thought it might do in a year or two. And then, like, I immediately started like dollar cost selling it. That is like differently than I would behave for other stocks. So,
yeah, like a good example, one of my best examples that was lucky, I want to be clear, I would say it was half luck.
Take some credit. Come on.
Yeah, no, I would say it was half luck. It was TELUS. And if you take a look at the TELUS stock chart, that stock ran up to $34 Canadian. And at that price, the price ratios were extremely high relative to the company's growth. And I was like, this is ridiculous. I'm selling my position. I sold it at like $33.80. And I believe it topped at $34. So I just about top ticked it. I wasn't saying I thought the stock was going to crash or fall. I was just looking at the price versus the fundamentals versus the growth. And I was like, this is ridiculous. Like the price is too high. Sold it. Now the stock, I think, is back down to $20. And that was like 2.5 years ago. So if I held on to it, and it was a decent position in my portfolio at that time. So if I held on to it, I would be down, I don't know what the math is right now, probably like 40-ish% over the past 2 years. Whereas I took that gain and I deployed it elsewhere in my portfolio, and now that money has continued to grow. So it's like, in hindsight, that was a absolutely perfect thing for me to do. Is that going to play out with Google if I end up selling it? I have no idea. Is it going to continue running? I have no idea. When I sold Meta, it doubled. Like,
and more than double.
More than. Well, no, it's probably about a double today. I sold around like 250. So yeah, currently it's less than a double, but it did more than double. So it's like,
okay, I thought it was more like 180, 200, but yeah, we'll say double. But yeah, you're making a good point, right? Yeah, all your points are great, and I think the other context, the chat's going off about this, which is great. I mean, there's a lot of smart people in here. Paulo PG mentions like tax events as well. I mean, this of course varies per person, but like it is good to know, like if you sell a win, you're going to owe taxes to the government, right? Like that should be a part of your strategy. And I'm really happy Rob H said this as well. Great to see you again, by the way. Because this is the first thing like I thought. Joesph Carlson had a great tweet, and I think, it's really in line with everything we're saying here. And it was about Costco, because the biggest flack he gets for that investment is look at the multiples, look at how expensive it is. And you can make a fundamental argument where it's like, hey, like a lot of this stock price appreciation is coming from multiple expansion. This stock looks very expensive on paper. And like Joesph doesn't deny that. He's like, look, like I understand that today, that's what it looks like. But his whole thing is at the rate that they compound and grow, that it, of course, over time, the yields on cost that he's getting, it basically grows into that valuation. And then it's the whole gray area of investors having friendly arguments with each other about like, okay, is 50 times earnings actually fair? Because if you double that twice, I mean, then you're going down to 12 and a half, like on cost a couple of years out, which was actually then in hindsight, like a pretty good buy, assuming that stock is still growing. So yeah, very deep topic. And yeah, I'll have a lot of thinking to do here, because right now, like I'm holding my Google, by the way. I'm not planning on moving things around, but there might be a level where like I feel uncomfortable, right? If the like free cash flow yield gets down to like 1.5%, like that's
well, we'll also see with earnings. Like my big thing is I'm trying to debate, because Google reports earnings next week. So I'm like, do I want to do it before or after earnings? But then honestly, that's just like me kind of speculating on what I think is going to happen after earnings, which I have no idea. So either way is a gamble. There's no easy answer, man. There's just no easy answer. One thing about Joesph Carlson, though, by the way, he is like my favorite other investing YouTuber, even though him and I aren't really friends. Like I would say we're acquaintances, but like we've never had a one-on-one chat or anything like that. So I wouldn't call us like friends,
Not yet.
Not yet. I'd be down to collab with him anytime though. Like friggin' great guy.
Yeah, someone send him this video.
But the what's interesting is he sold Chipotle. I believe on Twitter he announced that he sold Chipotle this morning because of the overvaluation, but he's holding on to Costco. So like I'm just interested in his thought process, because then my question is like, Costco, in my opinion, is, well, maybe not. Maybe it's like equal, in my opinion, overvalued level to Chipotle. So then I would ask him, like, why are you holding Costco and selling Chipotle? And is it just because you have more conviction on Costco? Like, that could be an interesting conversation. Maybe he'll explain that in his next video. I don't know.
I'll go into prediction markets and put my money on, just from reading his content, that it's like about the growth rates. Like when he looks at the future of Costco, that they get subscription revenue, where they can put more stores and things like that in their competition. Like I think that they actually have like a way bigger moat with their pricing power. Network effects from that is like similar to a Walmart, where it's like it's hard for people to come into and compete. But Chipotle, maybe they topped. I've actually stopped going to Chipotle recently because the bowls have gotten so bad and like underserved. And like I just question what their future growth is. So I would think that would be his answer, because like he usually formulates his investments similar to us actually on like, okay, sure, like you want to feel good about the cost today, but you're really buying it in because you think it's going to have market beating returns based on the future earnings power, which is why you're holding Constellation Software, right? Like you firmly believe that they are going to compound their cash flows at a rate where the current high multiple is justified. So I would think it's the same thing.
Yeah. But also, yeah, like I'm not buying Constellation right now. I want to make that clear too. Like I'm not putting new money into the stock. It's just a hold for me. There's just like some stocks that I have where it's just easier for me to be like, this is one that I actually just want to hold for 20 years, and that's just my mind's made up. The decision's done. I'm not letting go of it. The only thing I'm looking to do is buy more, but it's not even close to a price that I would pay. So
Yeah,
that's how
I
it
think
goes.
we might. Sorry, what were you going to say there?
Nothing.
All right. Well, I think we might have time to look at one quick stock, or if anyone has questions about stock unlock and some of the features we've been dropping lately, we're happy to answer those. We're nearing like the end of the live stream here, so we normally kind of like go a little bit off topic, whether that be looking at a random stock or just taking live questions in the chat. If we don't see it in a few minutes, it's been like I was going to say fun week. It's only Thursday, but I'm going to the beach tomorrow. I wish that you can come with me. I know that there's no beaches up in Calgary. You guys have the beautiful Banff Mountains.
We sure
But anyway,
do.
you went through a heat wave up there, right? Because you said it was literally 95 degrees up there in Calgary, Canada. I did not know it got that hot, and it was not as hot in New York.
Yeah.
Which I thought was bizarre. I mean, how is that?
So where I live, the best way to explain it is we get the extremes on both ends. So like it gets to minus 45 degrees Celsius for like a week in the winter. And then it was 35 degrees Celsius, which is like 95 Fahrenheit last week. And my office is upstairs in my house with a black roof. Okay. So my office gets to like 40 degrees Celsius and I'm just dying. That's why I bought the AC unit.
Wait, you have the AC now, right?
Yeah, I have the AC now.
What is it like to have air conditioning? I know that that's been around for a little bit.
Fantastic. It was worth it. Definitely worth setting up and buying. Yeah, actually work again without like falling asleep and wanting to die. So it's good.
Dude, the weather in Canada seems insane. All right, if there's any other like United States layman people or like Euro people in here, I live in New York. So one thing that blew my mind was Daniel flew back to Calgary in the winter from a business outing we were on together, and his fiance had to bring snow pants into the car to pick up Daniel. Correct me if I'm wrong on any of this, because it was so cold up there, so negative below zero, that any exposed skin, it's not like, you might get a frostbite. Like, you will get frostbite and be in the hospital. So it's like you had to bundle up in order to even like get into the car.
Yeah,
I mean, like it gets cold here, dude, but like it does not get like that cold. I've never heard of anything like that.
No, it's also worth saying that we flew home from Hawaii. So I flew home from Hawaii to like literally negative 40 degrees Celsius weather, where I had to wear basically a ski suit to get into the car. Like it's crazy.
All right, let's get back on topic here for one last one. There's someone here that I don't recognize the name. Their name's very good. I'm not sure what stock they want us to look at. They sent the message AMZN about 5 or 6 times in a row, which borderlines on spam, but we'll take it. I think that there's.
I just talked about Amazon. I don't really want to talk about it again.
We did. Very good. If you're just joining, I would go back in the stream or watch the recording. We did actually just talk about Amazon a bit. The very brief one-sentence summary was out of big tech is not looking overpriced relative to the other stocks. Not financial advice, but if you check out the price to operating cash flow, it's not really out of control like some of the other companies. Novo Nordisk is up here. Would you mind taking a look at ING? And then someone else said Diego. So I guess we could pick one of those. And shout out to 69 viewers in the chat. Nice.
All right, I'm going to just quickly look at some of these.
All right, and this will likely be our last stock of the day. If you're just joining at the end here, we do try to do this once a month, and I'm going to drop our link to the free Discord we have. If you're not in there, it's a great place to talk to other investors and stay up to date with releases and things that we're doing on the software we're building.
All right, we're doing IREN.
Let's go. This is a new one for me.
Yeah, that's what I like. I like to look at new ones.
I liked looking at TOST in the beginning, too. For those of you that missed out, Daniel was eating a piece of toast, and someone brought up TOST Inc., ticker symbol TOST. We didn't like it that much, but it was a fun time.
This is the aftermath of the toast. Just crumbs.
Are your cats, like, licking the plate or anything?
No. Okay. All right. IREN. Iris Energy. Looks like it was $1 stock in 2022, so it's 10x in 2 years. If we scroll down, it engages in the operating institutional grade data centers powered by renewable energy. Companies headquartered in Sydney, 100 full-time employees. So it sounds, oh wait. Company data centers are purpose-built for high-performance computing and support a combination of application integrated circuits for Bitcoin mining and graphics processing units. So it sounds like they're a data center that also does Bitcoin mining.
Whoa.
Their revenue has actually been growing a lot, especially recently. Like, that's pretty insane growth. Shares outstanding has also grown a lot. It's actually doubled in 2 quarters. That's concerning. Cash flows are 60 million in the trailing 12 months. We're not getting a lot of stock-based compensation data here. Looks like that's interesting. Capital expenditures are very large. 174 million in the trailing 12 months. So this company is free cash flow negative, losing money. Okay.
I wonder how much of their assets are Bitcoin, like if they actually own the Bitcoins or if they're just selling it. I'm trying to compare their price to Bitcoin ETF because you do find, like with MicroStrategy and like some of these Bitcoin heavy companies, that they will actually trade and have their price very affected to the price of Bitcoin, just like some metals and other companies like trade similar to the price of their commodities.
Yep. Yeah. They do only have $46 million of liabilities, and their cash position right now apparently is 263 million. So their balance sheet's very strong. They are cash flow positive. The revenue is growing. So there's some things to like there. Not a lot of, no insider data. It is trading for 16 times sales, $2 billion company. With,
I feel like this is one of those where you have to go into the actual like 10K or 10Q because I'm just like, what are they doing? Are they holding the Bitcoin as their assets? Like, is it just the service? And then like, are they able to pivot to like AI workloads or anything like that?
I'm also
it does seem like a commodity type company. Like, what is their moat? What are they providing that no one else can throw money at and provide? Because I haven't seen that yet.
I'm also confused at like why their capital expenditures are so high. Like, this company is losing money. It's free cash flow negative massively. So I would want to know why that is. Like,
I have something to add here from the chat. Yeah, just for the person who brought it up. They mine Bitcoin with excess capacity and raised capital to build new data centers. Bitcoin gets sold the same day. So they mine and sell, and then they use that revenue to bootstrap into building more data centers to continue to sell. So
yeah, so their revenue then is probably highly dependent on what Bitcoin prices are doing.
Yeah.
I don't know. It's not for me, that's for sure. But I mean, it's growing. It's got a good balance sheet. Cash flow is positive recently. They are diluting a lot, though. I would also look into that, like lots of dilution. So I don't know.
Yeah.
I'm sorry I can't give like a better opinion here, but I like this one. It just seems like one of those really niche businesses that you gotta really understand.
Yeah, I mean, I can weigh in on the tech side because I get pretty nerdy and look at, like all the data centers and cloud services and things like that. And I do wonder like long term, because I like to invest looking at companies like 5 to 10 years out. Like one, I don't think this company is doing anything unique. Like I've actually heard of a decent amount of companies that are mining, selling, and like using that to like build infrastructure. And then secondly, like I get that they might be arbitraging like niche areas of the cloud computing market just for like running AI workloads or like training, like doing inference calculation. Like I'm seeing a lot of those come up. But then again, like what small of a pie are you fighting over? And then like what does it take for a mega player like Amazon or Google or Microsoft that have existing huge cloud services to start to like cover some of these like missing areas of the market? So it's the same concern I have over Stripe. Like I think Stripe is like, it's a private company, so it's a bit different, but I think they are arbitraging a like software gap in the market the last 10 years where like payment processing is hard. However, like as an engineer, I'm seeing more of these companies come up, and like I do wonder like what is the durability of that moat. And similar to here, like I'm not fully understanding the durability of their moat long term. And then since they are selling the Bitcoin, like you said, that's such a volatile asset, right? Like if Bitcoin halves in price again, I mean that's half the amount of revenue they can make, and if that's the only place where they're making revenue, that's a big bottleneck.
Yeah,
I'm a little concerned. All right. I think that's brings us to the end here. I'm gonna pause on ending it because I feel like I'll usually go through the ending spiel, and you'll find like one more comment you want. So take a look at the comments. Are we gonna take anything else here, or are we gonna want to close?
No, I'm good.
All right. I do see some other stocks here. We do apologize. We can't get to all of them. We wish we could. And we do this every month. So if there's stocks that you were looking to get analyzed that aren't there, throw them in our Discord. There's other investors hanging out, or come to the next show. This has been episode 55 of Stock Unlock Podcast. And thank you, everyone, for hanging out. Have a great weekend, Daniel. I'm going to miss you tomorrow. I wish that you can come to the beach with me.
Dude, maybe I'll show up. Maybe I'll book a flight. Let's go.
All right,
Thank you, everyone.
Bye.
Bye.
Everybody.